Here's something that should genuinely bother every retired American who pays federal income taxes. Right now, there are millions of seniors across this country who qualify for specific, real, IRS-confirmed tax breaks that could legally reduce their tax bill by hundreds, sometimes thousands of dollars, and they are not claiming them. Not because they're ineligible, not because they did something wrong, but because nobody told them the breaks existed, or because they assumed they didn't qualify without ever checking, or because their tax preparer didn't ask the right questions. Roughly 48 million Americans over the age of 65 were retired in 2024, according to the Bureau of Labor Statistics. More than 17 million Americans 65 and older are economically insecure, living at or below 200% of the federal poverty level. Whether you are comfortably retired or struggling, every dollar saved on taxes helps. As millions of Americans wrangle their federal income tax returns for 2025, there are 8 ways retirees can lower the amount they may owe the IRS, and most of them go unclaimed. Today on Professor Kingsley, we are going to go through every one of those overlooked tax breaks in plain, clear English, where they come from, who qualifies, and exactly what you need to do to make sure you're not leaving any of this money behind. Stay with me all the way to the end, because by the time we're done, you're going to know more about your retirement tax rights than most people who file their own returns. Welcome to Professor Kingsley. If you're new here, this is the channel where we take the tax and financial rules that affect everyday Americans, especially those in or approaching retirement, and explain them the way a trusted, knowledgeable friend would. No confusing legal language, no industry jargon, just clear, honest, practical information you can actually act on. If that's what you've been looking for, please hit the subscribe button right now and turn on your notification bell. We put out new content every week, and the tax and financial landscape keeps changing fast. You want to stay current. Subscribe now, and let's get into every tax break that millions of seniors are qualified for, but not claiming. Let me start with the newest one, the one that arrived in July of 2025, and that is already being missed by a significant portion of the seniors who qualify for it, simply because the awareness hasn't caught up with the reality of having to file a return. Effective for tax years 2025 through 2028, individuals age 65 and older may claim an additional $6,000 deduction on their federal income tax return. This is in addition to the standard deduction for seniors available under existing law. The deduction applies per eligible individual, meaning it is $12,000 for a married couple if both spouses qualify. It phases out for taxpayers with modified adjusted gross income over $75,000 for single filers and $150,000 for joint filers. This enhanced senior tax deduction of up to $6,000 for single filers and $12,000 for joint filers was created to help cover taxes on Social Security benefits for tax years 2025 through 2028. You can claim it if you itemize your tax deductions or if you choose to take the standard deduction. If eligible, you can take the deduction in addition to the other tax benefits for seniors, including the additional standard deduction. To be eligible, you need to have turned 65 on or before December 31st, 2025, and file as an individual, head of household, surviving spouse, or a married couple filing jointly. The deduction is not available to married couples filing separately. When you prepare your return, you indicate your date of birth. If you are 65 or older, the IRS will calculate your eligibility. A good tax preparation software program will flag your eligibility automatically and apply the deduction. If you prepare a paper return, be sure to check the age 65 plus box and include accurate Social Security numbers. Now here's what makes this so significant and so widely missed. Because it's new, and many taxpayers are still catching up on the details, it's worth asking your financial advisor or tax preparer whether you qualify. Many of these breaks go unclaimed every year simply because people don't know they exist or assume they don't qualify. Think about that for a second. A $6,000 deduction per eligible person sitting there, available on your 2025 tax return, and a substantial portion of qualifying seniors are either not aware of it or not checking whether it's being claimed. If you haven't specifically confirmed with your preparer that this deduction appears on your return, please do so before your filing is complete. The second overlooked tax break is one that has existed for years and that still remarkably gets missed by a meaningful number of seniors every year. It's the additional standard deduction for people age 65 and older that the IRS grants automatically, and that most people either don't know about or assume applies to everyone regardless of age. When you turn 65, the IRS offers you a tax benefit in the form of an extra standard deduction for people age 65 and older. For example, a single 64-year-old taxpayer can claim a standard deduction of $15,750 on their 2025 return. However, a single 65-year-old taxpayer will get a $17,750 standard deduction for the 2025 tax year, an extra $2,000. If you're married and one or both spouses are 65 or older, you also get a bigger standard deduction than taxpayers under 65. If only one spouse is 65 or older, the extra amount for 2025 is $1,600 and $3,200 if both spouses are 65 or older. For two married seniors, that's an extra $3,200 they get to subtract from their 2025 taxable income without doing any work or keeping any receipts. No receipts, no tracking, no documentation required. You turn 65, and the IRS gives you a higher standard deduction automatically, as long as it's correctly reflected on your return. The problem is that people file returns using the wrong standard deduction amount. Preparer error, software that didn't ask for your date of birth correctly, a paper return where the wrong box was checked. Any of those errors can result in you claiming a lower standard deduction than you're entitled to and not receiving the tax benefit you legally should. Now layer in the new $6,000 enhanced senior deduction from the One Big Beautiful Bill on top of this. The new deduction can be stacked on top of the existing exemption for seniors and the visually impaired, which is $2,000 for individual filers and $1,600 each for married couples filing separately. Both are distinct from the standard deduction that most taxpayers can claim. The total deduction stack available to a senior in 2025, regular standard deduction, plus age-based additional standard deduction, plus the new enhanced senior deduction, can reach $23,750 for a single filer and over $46,000 for a married couple where both spouses qualify. That is an enormous shield of income protected from taxation, and it's sitting there waiting for anyone who knows to claim all three pieces together. The third overlooked tax break is one that requires a little more strategy, but has one of the highest potential values of anything we'll discuss today. It's the Qualified Charitable Distribution, or QCD, and it's available to anyone 70 and a half or older who has a traditional IRA. If you're 70 and a half or older with a traditional IRA, there's a far more tax-efficient strategy than writing a check: the Qualified Charitable Distribution. You can donate up to $108,000 a year in 2025 directly from your IRA to a qualified charity, with married couples able to donate up to $216,000 combined. The contribution counts toward your required minimum distribution, but it doesn't show up as taxable income. The QCD strategy is particularly valuable for retirees who take the standard deduction. You get the tax benefit of charitable giving without needing to itemize. Even better, keeping that IRA money out of your adjusted gross income can keep you from crossing into a higher bracket or triggering taxes on Social Security benefits. For 2026, the QCD limit increased to $111,000 per individual directly from your IRA. This could lower your taxable income and may prevent you from reaching phase-out limits for other deductions you may qualify for. Here's the practical significance of this. Most charitable retirees withdraw money from their IRA, pay income tax on it, and then donate what's left from their checking account. If they itemize, they get a charitable deduction. If they don't itemize, which most retirees don't, they get no federal tax benefit from the donation at all. With a QCD, the money goes directly from the IRA to the charity. It never touches your income. It's excluded from your adjusted gross income entirely. The result is that your taxable income is lower, which may protect more of your Social Security from being taxed, may protect you from elevated Medicare premiums 2 years later, and may keep you in a lower tax bracket. All from a charitable donation you were probably going to make anyway, just done through the right channel. The mechanics are simple. You call your IRA custodian and request that they send a check made payable directly to the qualifying charity. Not payable to you and then passed on directly to the charity. That one procedural detail is what makes the tax treatment work. Miss it, and you've made a regular taxable distribution. Get it right, and you've made a tax-free charitable transfer that serves your retirement finances as much as it serves the charity you care about. The fourth overlooked tax break is one that is especially relevant for retirees who have been paying significant medical expenses and not tracking them, or who have been tracking them but never sat down to check whether they exceeded the deduction threshold. It's the medical expense deduction on Schedule A. To take advantage of this deduction, your total medical and insurance expenses must amount to at least 7.5% of your adjusted gross income for the year. HHS estimates that an American turning 65 in 2025 will incur $120,900 in future long-term services and support costs over their lifetime. Average annual costs in 2024 ranged from $26,000 for adult daycare to $127,750 for a private room in a nursing home. You may also be able to deduct the cost of long-term care insurance premiums, but the deductible amount depends on your age. You can deduct qualified medical expenses that exceed 7.5% of your adjusted gross income. Retirees often have higher medical expenses, and some of those costs may be deductible if you itemize. Here's the comprehensive list of what qualifies as deductible medical expenses, and it's broader than most people realize. Medicare Part B and Part D premiums, dental work, hearing aids, prescription eyeglasses, prescription medications, out-of-pocket costs not covered by insurance, long-term care insurance premiums up to the age-based IRS limit, mileage driven to and from medical appointments, home modifications made for medical necessity wheelchair ramps, grab bars, walk-in tubs. For a retiree with a $45,000 adjusted gross income, the 7.5% floor is $3,375. Any qualifying medical expenses above that amount are deductible. Between Medicare premiums, dental work, prescription costs, hearing aids, and long-term care insurance premiums, many retirees clear that floor without realizing it, and they take the standard deduction year after year because they assume itemizing won't help them, without ever running the actual numbers. If you haven't compared your itemized deduction total, including medical expenses, to the standard deduction for your filing status recently, it's worth doing the calculation. Especially in years when you had significant dental or medical expenses, the itemized route may produce a meaningfully larger deduction than the standard option. The fifth overlooked tax break is one that the self-employed seniors and part-time consulting retirees in the audience especially need to hear, because it's one of the most powerful above-the-line deductions available, and most people in this category don't know it applies to them. If you become self-employed after you retire, for example, you become a consultant, you can deduct the premiums you pay for Medicare Part B and Part D, plus the cost of supplemental Medicare Medigap policies, or the cost of a Medicare Advantage plan. This is an adjustment to income, rather than an itemized deduction, for premiums you paid on a health insurance policy covering medical care, including a qualified long-term care insurance policy for yourself, your spouse, and dependents. The Medicare Part B standard monthly premium for 2025 is $185, which translates to a potential deduction of $2,220. Above the line means the deduction happens before your adjusted gross income is calculated, which is far more powerful than an itemized deduction that happens afterward. It reduces your AGI directly, which in turn reduces how much of your Social Security is taxable, reduces your IRM-AA exposure for Medicare premiums in 2 years, and may protect you from losing other income-sensitive deductions and credits. If you have any self-employment income whatsoever, even a small consulting practice, a few freelance projects, a part-time business, and you're paying Medicare premiums, this deduction may be available to you and is absolutely worth asking about. The sixth overlooked tax break is a credit, and I want to make sure you understand the distinction between a credit and a deduction because it matters significantly. A deduction reduces your taxable income. A credit reduces your actual tax bill dollar for dollar. A $500 credit is worth $500 off what you owe. That's more powerful, and it's why the credit for the elderly or the disabled deserves its own dedicated mention in this video. What's better than a tax deduction? A tax credit. A deduction lowers your taxable income, but a credit reduces your tax bill dollar for dollar. The Savers Credit, also called the Retirement Savings Contributions Credit, isn't specifically for retirees, so they might easily overlook it. The tax credit is available to any eligible taxpayer who is saving money in a retirement account. That means retirees who are still able to contribute to a retirement account, assuming they otherwise qualify for the credit. For the 2025 tax year, the maximum income amount for claiming the Earned Income Tax Credit is $68,675. The amount of the credit may vary based on income, family size, and filing status. Beyond the Savers Credit, the credit for the elderly or the disabled is specifically designed for seniors who are either 65 or older, or who retired on permanent and total disability. It's a direct dollar-for-dollar reduction in your federal tax bill. It's calculated on Schedule R, and it has been one of the most consistently underused credits in the entire tax code for decades. It has income requirements that limit it to those with relatively modest income, but for seniors with low Social Security benefits and limited other income, it can be a meaningful benefit. If you've never specifically asked your preparer whether you qualify for Schedule R, ask now. The seventh overlooked tax break connects to a provision inside the One Big Beautiful Bill that flew under the radar for most retirees and that offers a real benefit for the charitable givers in the audience who don't itemize. Under the new law, seniors filing jointly who don't itemize can deduct charitable contributions up to $2,000 on a married filing jointly return. For single filers, the deduction is $1,000. This above-the-line charitable deduction is now available for non-itemizers. This matters because the Tax Cuts and Jobs Act of 2017 made the standard deduction significantly larger, which caused the majority of retirees to stop itemizing. And when they stopped itemizing, they lost the tax benefit of any charitable contributions they made. The standard deduction gave them no credit whatsoever for their giving. This new provision partially corrects that, giving non-itemizing retirees a modest but real deduction for charitable donations, on top of the standard deduction, without requiring any itemization at all. It's not a large deduction in absolute terms, but for a married couple in the 12% bracket claiming the full $2,000, that's a $240 reduction in their actual tax bill for charitable giving they were already doing. No new behavior required. Just the right box checked on the right form. The eighth overlooked tax break is one that benefits a specific but significant group of retirees, those who have a working spouse while they are not working and who have been assuming that their retirement status eliminates their ability to contribute to an IRA. Generally, you must have earned income to contribute to an IRA. However, if you're married and your spouse is still working, they can generally contribute up to $7,000 to a traditional or Roth IRA that you own a spousal IRA. The 2026 IRA contribution limit increased to $7,500. If your spouse has enough earned income to fund the contribution to your account and their own, you are eligible for this tax benefit. Total combined contributions cannot exceed $17,200 for 2026 if both of you are at least 50 years old. A working spouse can help a non-working spouse save money in a retirement account. Spousal contributions to a traditional IRA also qualify you for a tax deduction, assuming you meet eligibility requirements. For a retired spouse whose partner is still earning income, this creates an ongoing opportunity to contribute to a Roth IRA, a growing tax-free wealth that will never be subject to required minimum distributions and that produces completely tax-free withdrawals in later retirement years. Or to a traditional IRA, which may produce a current year tax deduction that reduces taxable income right now. Either way, the spousal IRA provision means that retirement doesn't automatically end your ability to contribute to tax-advantaged accounts, and the couples who know this have a meaningful advantage over those who don't. Now let me tie all of this together with the one concept that the most informed retirees understand and most others don't, which is that these tax breaks don't function best in isolation. They function best when layered together deliberately. Think about what the optimal 2025 tax return for a qualifying senior looks like when everything is claimed. You have the regular standard deduction of $15,750 for a single filer. You add the age-based additional standard deduction of $2,000. You add the new $6,000 enhanced senior deduction. You execute a $5,000 QCD from your IRA that satisfies part of your RMD without touching your AGI. You claim the new $1,000 non-itemizer charitable deduction for other giving you did during the year. You review your medical expenses to see whether they might tip you into itemizing territory. And you verify with your preparer that all of these are correctly reflected on your return. That's a comprehensive approach. That's the approach of a retiree who treats tax planning as a year-round activity, not a once-a-year scramble in April. And the difference between that approach and simply handing your documents to a preparer and walking away without asking questions can be thousands of dollars legally, transparently, and completely within the rules the IRS has set. Nearly 17 million Americans ages 65 and older are economically insecure, living at or below 200% of the federal poverty level, making every dollar saved on taxes a win. The good news is that with tax season open, there's still time to claim these deductions and credits available specifically for retirees. Many of these breaks go unclaimed every year simply because people don't know they exist or assume they don't qualify. That last sentence is the one I want you to carry out of this video. They go unclaimed because people don't know or assume they don't qualify. You now know, and you should check every single one. Before we close, I want to give you a practical action list because information only creates value when it leads to action. Action 1. Verify that the $6,000 enhanced senior deduction is on your 2025 tax return if you are 65 or older and your MAGI is below the phase-out threshold. It should be on Schedule 1A. Ask your preparer by name if you're not filing yourself. Action 2. Confirm that your age-based additional standard deduction is correctly reflected $2,000 for a single filer 65 or older in 2025, and $3,200 for a married couple where both spouses are 65 or older. If you're filing a paper return, double-check the box. Action 3. If you are 70 and a half or older, own a traditional IRA, and give to charity, initiate at least some of that giving through a qualified charitable distribution before year-end. Call your IRA custodian. Have them send the check directly to the charity. Action 4. Add up every qualifying medical expense you've paid this year. Compare the total to 7.5% of your AGI. If you're above the floor, run the numbers to see whether itemizing produces more than the standard deduction for your situation. Action 5. If you have any self-employment income, ask your preparer specifically whether your Medicare premiums qualify for the self-employed health insurance deduction as an above-the-line reduction to your AGI. Action 6. Ask your preparer whether you qualify for the credit for the elderly or the disabled on Schedule R, and whether you qualify for the new non-itemizer charitable contribution deduction of up to $1,000 for single filers or $2,000 for joint filers. And Action 7. If you are in a household where one spouse is still working and the other is retired, discuss whether a spousal IRA contribution makes sense for your situation in 2026. That's the list. 7 actions, every one of them legal, IRS confirmed, and available to qualifying seniors. The question is whether you take them. Before you go, 2 things. First, share this video with one person who needs it. Think of a friend, a parent, a sibling, a neighbor who is retired or close to it and who hasn't thought much about these specific tax breaks. Hit the share button right now and send this to them. The information we covered today could save them real money, hundreds, potentially thousands of dollars, and you'd be the one who made that happen. Second, drop a comment below. Tell me which of these tax breaks was the most surprising to you today. Was it the new enhanced senior deduction, the QCD strategy, the non-itemizer charitable deduction, the spousal IRA? Tell me what you were missing, and tell me what question you want me to dig into next. I read every single comment, and the Professor Kingsley community is genuinely one of the most informed and engaged groups of people I've ever had the privilege of connecting with. This is Professor Kingsley. Stay informed, claim what's yours, and I'll see you in the next one.